Harry Markowitz in 1952 suggested that the asset allocation puzzle should consist of not only a return argument, as what was previously done, but should also consist of the understanding of the risks associated with asset classes. To this end, the Markowitz efficient frontier was born. As a definition, it's where no added diversification can lower the risk of a portfolio for a given return expectation. But is this really the way to decide asset allocation, or could bottom-up stock selection not play a far bigger role? On that note, welcome to all of you once again. Cobie, we keep talking about bottom-up approaches versus top-down approaches, and you're going to give us a concise definition of both and why both of them are really important in terms of investment and portfolio management.
Eleni, let me show you some things quickly. You know, having looked and analysed quite a few fund managers over time, there's really two processes that drive asset allocation in an asset management business. The first one being a top-down process. Now, Eleni spoke a little bit earlier on about Markowitz and the efficient frontier. And really speaking, if you're doing forecasting as far as asset classes are concerned, and you're looking at the risks, which generally is historical, that would really lie in a top-down process. A top-down process often looks at economic factors, it looks at currency drivers, and various other things that you see on screen over there at the moment to signify what asset allocation is. And then the second portion of the argument is obviously a bottom-up process. And this is where the fundamentals come into play. It's looking at the specific asset classes. It's understanding what is driving those asset classes, and then potentially what kind of stocks you should be or assets you should be buying in each one of those asset classes. Maybe the bottom-up and the top-down process regarding asset allocation is maybe a little bit to do. It's got something to do with maybe the skills that are inherent within a specific investment team. Certain cases, much more bottom-up. People are potentially, or professionals are potentially in an asset management business, where in other cases, maybe they're more economically focused, which is much more top-down driven. But those are kind of the two big areas that kind of drive asset allocation. Eleni, back to you.
Okay, so Roland, I mean, we've heard some interesting points there. It's got to do with skill. You look at the macro environment, you also look at some of the value that is being offered by various stocks and various asset classes. But don't you think it's an amalgamation of both strategies that makes a fund manager the best in terms of what we see in the South African scenario and on a global scenario, or is it about picking one or the other?
The interesting thing, I mean, the topics you hit the nail on the head there, is how do you separate the stock picking from the top-down allocation? And a lot of research is showing that it's actually quite difficult to separate them, because I'll give you an example. If you investing in Sasol, in other words, you've got some cash in your portfolio and you want to increase your allocation to Sasol. So let's say you invest 2% of your fund in Sasol. You might be thinking in stock picking terms. You like the stock, it's cheap fundamentally, this is a good buy. But actually you're also doing a top-down allocation, because you are increasing your equity allocation by 2% by buying more stocks. So trying to separate those two is actually very difficult. So I'm actually going to sort of claim tonight that it's stock picking and top-down investing is actually very much overlapped by definition, because one has to come with the other one. You can't stock pick and not be active from a top-down perspective, but it's where your focus is that really matters.
I mean, you know, and I think that's the important thing here, is potentially maybe just to get Linda into this debate over here. Linda, at what point does stock selection play the kind of the significant role that it should in order to allocate assets? Because, I mean, at the end of the day, if you've got a top-down process, and my experience certainly is this, when you've got a top-down process that kind of looks at forecasting equity returns or forecasting asset class returns, and where your risks are by default historical, then it doesn't really leave room for the stock selector in order to actually, you know, get into the process by saying, well, maybe there's opportunity in this asset class, because these things are kind of more stagnant.
Yes, I just want to sort of touch on something that Roland said earlier, which is that at ReCM, you know, we're bottom-up value investors, so we don't have a top-down investment process. But I would agree with Roland when you say that it's very difficult to say what is your bigger driver of returns. Is it actually bottom-up stock selection, or is it how exposed you are or aren't to the equity market? Our argument is that asset allocation should actually be a byproduct of that bottom-up selection process. And why I say that is that there you're focusing on more tangible things with regards to the fundamental valuations of businesses, whereas many top-down investment processes, as you say, rely on economic forecasting as a starting point. And we know, first of all, that it's almost impossible to consistently forecast economic macro variables, and secondly, there's a big debate as to how useful they are in dictating where to invest.
Well, Linda, wouldn't you say that a company is cheap for a reason and it's offering value for a reason, and usually it's because of macro factors, macroeconomic factors that are having an impact on the company? Don't you look at those factors as well and say, well, are we getting ourselves into a value trap? Could we see more bottoming out when it comes to its share price? How do you decipher that there is a balance when you look at a company?
Well, yes, you're quite correct that where there is a negative macroeconomic news, that's often where value opportunities exist. Because we know that for equities, for companies to be cheap, especially high quality companies, which is our focus, there has to be negative news. They have to be unpopular for a reason. Good quality companies just don't become cheap when things are going well. So that is often an area where we will start to look for value. But our entire investment decision rests on what is this company actually worth and what is the market asking for it. And if the difference between that is 30% or more, and we call that the margin of safety, then we will allocate investment capital to that particular security.
Linda, maybe just a question quickly. You know, if you look specifically at the Markowitz process, the Markowitz process allows from some quantitative perspective to allocate money to specific asset classes. Now, how do you do it from a bottom-up perspective? Because if you've got a bottom-up process, at what point do you become overweight equities, or at what point have you got what signifies the allocation to equities? Is it 90? Is it 80? Is it 50? Should it be 20? What drives that process, and how do you determine that at the end of the day?
For us, it's merely a function of how many investment opportunities can we find today that are high quality and where the market is asking for significantly less than what the company is worth. And the amount of exposure we have to the equity market is simply how many of those ideas can we find. If we cannot find enough of those investment ideas, which is typically the case when you have an overvalued market, we then defer to cash. And we have a word for that, or a term for that, which is deferred alpha. Currently in South Africa and globally, the markets are overvalued at the aggregate level. We are still finding value opportunities, so any equity that we hold, we still believe is undervalued, but there aren't enough of those equity opportunities for us to use up all of our cash. And if you look at our asset allocation track record, that has proven to be a very effective way of deciding whether to be in or out of the market.
Well, with regards to risk, Roland, perhaps you can add a little bit of light on this. We know we've spoken about specific and unspecific risk that we could find within a portfolio, and I know according to some of the theories out there that within an asset class, depending on the stocks in which you invest, you could actually counteract some of the risk that perhaps a construction stock would offer you relative to what a more diversified or defensive stock could offer you.
Absolutely, the risks are critical, and one of the risks, I mean, you basically telling the story of the deep value investor here, sort of contrarian investor. But one of the risks with that strategy can be where you are looking for companies that are in that safe margin of safety that are cheap, less than 30%, more than 30% undervalued. What often happens in the markets is markets move in terms of sector trends. So resources are doing really well or are really cheap, or financials are really cheap, or construction stocks are really cheap. And because of that clustering, what can happen is you end up finding all the cheap opportunities in one sector. And you have to be really careful that you don't buy, for example, at the moment, financials are relatively to the performance of the other sectors quite cheap. So financials are maybe at that margin of safety, but they're all there. So if you're a stock picker, basically you're just overweighting financials, for want of a better word, and you can't just have financials in your portfolio, because then you're not diversified and your risks are going to go up. So how do you be cognizant of the fact that you can end up in one sector, because that's where the value is and that's what you're trying to get, and you might not be as diversified as you'd like to be.
Yes, well, this whole concept of risk is a very interesting one, because when you talk about Markowitz, efficient frontiers and the likes, they use volatility as a measure of risk, and we don't think that volatility is actually a very good measure of risk. And the reason for that is that volatility measures both upwards and downwards movements. It measures short-term and long-term movements. And it also doesn't speak to the inherent risk in a position. So what do I mean by that? When everybody's doing the same thing, which typically tends to happen at the end of a bull market, everybody is still following the momentum, there is actually very low volatility in the overall market. Now, that certainly doesn't suggest that the risk in the market is low. And yet, we would often hear in the industry that high volatility equals high risk. In fact, if you look at volatility, it spikes when markets collapse. And we would say that when volatility is high, it's high because there's uncertainty. And uncertainty creates opportunities. And so in that kind of environment, that's where we would look for the undervalued opportunities.
But what if they're all in the same sector? That's sort of what I'm trying to get. Never mind the volatility. I'm talking about if all the cheap stocks are in financials, you sort of can't just buy financials, right? And you might have some in cash because you're saying there are not enough stocks in terms of opportunities. But how do you diversify? I guess you've got to find enough stocks in different categories to try and not focus too much on one sector.
Absolutely. So our process, first of all, is to look at high quality, and by that we mean companies that have barriers to entry, pricing power, sustainable competitive advantages. The second thing is to have that margin of safety where you're able to buy it at more than 30% discount to fair value. And then we have two further things that we do which help guard against that inherent risk in each position. We look at the popularity of the security, and we look at the cycle of the industry in which the company operates. And we basically allocate our position in terms of the size of the position based on those two things. Now, the more unpopular security is, the more we tend to like it, the more we're prepared to allocate to it. Why? Because we're trying to guard against moving with the herd. We're trying to essentially guard against the risk of falling into the trap of following the crowd. So we will allocate a bigger position to something that we've already established is cheap and it's unpopular. The second thing is the industry. Where in the cycle are we? If it's at a low point in the cycle, then we'd be prepared to hold a bigger position there. And why do I say that? Because the market tends to look at the earnings today, irrespective of whether you're at a high point in the cycle or a low point, and extrapolate that into the future forever after.
But then how do you decide as to whether the company has in fact reached the bottom or not? You know, at the end of the day, you've got to look at the macro environment. And you alluded to it a little earlier, and you've also got to protect yourself from risk. And I'm sure you've gotten into a position where you have experienced value traps and you have been burnt before.
Absolutely. And the thing with value investing is that you are looking where other people often are not interested, often at things which are unpopular. So sometimes you'll buy something because it's trading at 30% or less than it's what it's worth, and it'll go down even further. So it'll become 40% less than what it's worth. And with value investing, you don't make a call on when that's going to stop and when that's going to turn around. And that's the crucial difference between forecasting and value-based investing. Value-based investing is about identifying misvaluations in the market and waiting for them to be corrected, as opposed to saying when they're going to be corrected.
But that's the risk, because it could take 3 years before the market realizes what you might have realized, and you could be wrong for 3 years, right?
Quite correct. And if you look at the lead up to the financial crisis, we were underperforming because what we were holding, first of all, wasn't driving the market higher. It wasn't the speculative stuff which drives markets to its extreme levels. And second, we had a bigger cash portion. Yes, you do tend to have short-term underperformance with value investing, but time and time again, value investing has proven itself because it protects better against downside risk. And we have a saying at RCM, I don't think we came up with it, but we certainly live by it, which is that the winner is not the one that makes the most when markets go up, it's the one that loses the least when markets go down. And our track record demonstrates that.
So Cobie, when it comes to asset allocation, and let's allude to some of the points we made at the top of the show, bottom up versus top down approaches that we've seen. So how should it work in your mind? Should the stocks within asset allocation decipher how much you actually allocate to specific assets class, or is it about the other way around, that you decide at the top, where you go, well, this is our strategy going forward. We believe that as a whole, equities should outperform cash, so therefore buy as much equities as you possibly can and be underweight cash.
I always say that investors should understand what their asset managers are trying to achieve for them. And that's both from a philosophical and from a process perspective. And if you want a no-holds-barred type process to asset management, then you have to go value, and you have to go deep value, and you have to give your manager the ability in order to swap into equities and out of equities at those times, at times when the market is not favorable. Now, the problem that you've got with that is that if you've bought wholeheartedly into the process, and there are times where you underperform, well, you're going to have to be happy with that. But if there are times, that invariably then leads to a time where you are going to outperform. And that obviously is the cream that you've been waiting for, for not having had returns in the end of the cycle at the previous stage. There's a risk attached to that, though. And the risk obviously is that you don't get the returns when everybody else is getting returns. But that means philosophically and from a process perspective, you have to buy into them. You see, the biggest problem that we've got in the industry today is that from a top-down and a bottom-up perspective, often people divorce those two. If you're going to have a top-down approach, at least make sure that your bottom-up approach feeds into that, so that at least signifies from an asset allocation perspective exactly how much you should be holding them. Because often the one is set by a strategist and the other one is set by a fund manager, and those two sometimes
do not really, work
don't
together.
really talk to each other.
But we keep saying that it's really good to be in a balanced fund. So in other words, you've got a little bit of everything. You're slightly into gold and cash and bonds and treasuries and a bit of equities. What do you make of that approach?
Well,
is it okay to move away from that traditional view?
You see, that's diversification. And diversification long term, just from a volatility perspective, reduces volatility if your normal definition of volatility is standard deviation. And that's fantastic. There's nothing wrong with that. But understand that you're going to get a watered down return relative to what a manager does that gives you a purist view as far as equities are concerned when markets are cheap. Remember the caveat that we've got in the show. Buy cheap, get return. Don't buy cheap, don't get return.
Yeah.
That's the correlation between price earnings ratios
risk
and
comes
long-term
into
returns.
play as well.
That sounds far too easy. Buy cheap, sell high. It's easier. It's harder than that, right?
Well, I mean, it is harder than that. It is harder than that. But that's the game that we're in. Okay, the rules are easy, the game's difficult. And you could have sat late 1990s in the American market, where as a value manager you would not have found any stocks to buy because the P's were just climbing and climbing and climbing. What do you do as a deep value manager? Well, you've got no choice. You've got to go sit in cash.
Okay, so what do you make, Linda, of growth funds and growth portfolios where you're buying into a company, so you're paying a premium for it, but it's safe and it should outperform over the longer term?
Well, it's difficult to actually clarify exactly what growth is. And if it's dependent on projected earnings, for instance, then often those earnings projections turn out to be incorrect. And we are not in the speculative game. I just want to challenge something that Cobie said a little bit earlier, which is that you might miss out when the market is running if you take the value-based style. We don't believe that that is the case. Yes, in the short term, the market might run ahead of a value-based portfolio. But when the market turns, that value-based portfolio is going to outperform any style that has followed momentum to the top of the market. Why is that? Because if you follow to the top, you're going to fall when the market falls as well. If you've managed to protect capital ahead of that term, and that's the key thing, you have to do it before the turn, then you will end up over the full market cycle delivering better real returns above inflation.
I mean, and the caveat to that, obviously, is that investor behavior is aligned to the manager behavior. And that's philosophy and process. So if you buy into what the manager does and you're not getting these late stage type returns out the market, that's okay, because from a philosophical perspective, you know that it's going to come back at some point. But what we find is that often investor sentiment and investor behavior is not aligned to what the manager does. So you find these late stages where managers then underperform because they're not getting the returns, and guess what? Investors take their money off the table and they go and they do something else with the money, which is not necessarily always the best thing.
Okay, so on that note, we're going to leave it there, and when we return, we're going to be focusing on our Fund Focus segment. As mentioned before, ECM Global Fund will be under the spotlight. We'll see you right after this.